Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Debt deal done. Well, as I suggested in the last episode of the Investor's Edge, the debt ceiling was resolved without coming nearly as close to the abyss as many people thought that we might. And after a modest amount of market volatility here in the past week, stocks now seem to be in full control of the upward trend that began last fall. Now, I also talked about the possibility of interest rates moving higher when the Treasury begins the process of refilling its coffers with their newfound borrowing power. Much of the rise in stock prices this year has been a result of valuation expansion, as opposed to a rise in earning power. Now, while the former could be predictive of the latter, it may also be false hope based on the idea that the Fed will no longer hike interest rates, allowing for more expensive equity prices, all things equal. And while the Fed may indeed stop raising short-term rates, there is a distinct possibility that longer-term rates could move substantially higher due to a surge in new Treasury bond issuance, less demand for Treasuries from foreign governments, and the significant longer-term fiscal challenges that we still face here in the United States. Higher long-term rates could undermine the high-flying growth stocks that have powered the stock market so far this year. Not to mention, put further pressure on an economy that's already showing signs of a meaningful slowdown in economic activity. For this week's featured insight, unloved dividend stocks worth a look. Now, with everyone out there chasing growth stocks and everything AI, there may be an opportunity to take the road less traveled. That is, boring stocks that pay dividends. While the tech-filled NASDAQ stock index is up roughly 20% just in the past 3 months, the dividend aristocrats, which includes stocks that have increased their dividends for at least 25 consecutive years, are actually down around 3% over the same time frame. Dividend-rich sectors like the utilities, energy, and consumer staples are all down roughly 7% in the past month alone. So let other investors succumb to the greed and fear of volatility and take advantage of high-quality companies that pay dividends while they're on sale. Looking ahead, summer of volatility. So market volatility has subsided in recent weeks, but don't expect it to stay that way. While the market has become more comfortable with the geopolitical threats we face, they're still out there, and any number of different powder kegs could present a catalyst for market volatility going forward. The biggest challenge, however, is that a slowing economy is on a collision course with tighter monetary policy and reduced liquidity in the financial markets. The lower trading volumes that occur during the summer months could exacerbate the tighter liquidity conditions and cause for larger swings in market prices for both stocks and bonds. Now, you can use volatility to your advantage with options, generating income while positioning yourself to buy on market pullbacks and sell on market rallies. Just be sure not to panic and sell quality investments when they decline, and alternatively, don't get too aggressive and chase the market by buying after big rallies. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.